Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal, with me as always, Hormis Fatakia and Reema Tendulkar. Good morning, guys. We come back after a holiday, so fresh as we can be, but the Nifty, a little tired, I think, but yes, it has recovered from the lows again. So the Sensex has turned into the green after being in the red for a while. Nifty did see almost 100-point downtick from the highs of the day, but it is attempting some recovery as we speak. So 32 points lower right now after the recovery that we are talking about currently. The mid caps, they are underperforming, 0.4% down. The advanced decline ratio is in favor of the declines. So there are more declining stocks, around 2,100 of them versus 700 stocks on the advancing side. We have some stocks in the Nifty pack which are at the day's high. There's Ultratech Cement, there's Cipla, Dr. Reddy's, Wipro, TCS. So some of these stocks should be on your radar. But earnings, they continue to be the focus point, and a lot of action that we're seeing otherwise in the market as well.
Indeed, and Hormis will get to these individual stocks, but some that stand out. Look at something like an IGI. The street was so worried about IGI because of the rise in lab-grown diamonds, etc. But this time, the numbers look good. 21% top-line growth, higher than the revenue growth we've seen in the last 2 quarters. And stocks like that are racing away. But for more individual movers and shakers, Hormis is now standing at the big wall. Hormis.
It's difficult to put a list of stocks when there are almost 100 reacting to results over the Tuesday and on yesterday's holiday as well. But there's some positive earnings reactions and some negative earnings reactions. Let's start with the positive ones though. CCL Products is up 12% as of now. We have already 40 lakh shares that have been traded. The 20-day average is less than 30,000 shares. Reddington also seeing double-digit gains today, but look at the volumes here. 2.5 crore shares have been traded. The 20-day average is just 13 lakh shares. And same is the case for Gujarat Pipavav. The stock is up almost 8 to 9%. And 1.5 crore shares have been traded compared to a 20-day average, which is just 6 lakh shares. There are a lot of negative earnings reactions that have come in today, and EPAC Durables is one of them, down over 10% now. 18 lakh shares have been traded. Here too, the 20-day average just 1.5 lakh. Delivery is down 7% after its results. Here too, more than 1 crore shares have changed hands. The 13 lakh is the 20-day average with almost 7x of that. And Grasim, of course, news flow, earnings, all of it coming together with the decline that's been seen in the stock today. 7.5 lakh shares have been traded. The 20-day average only less than 80,000 shares. And Reema mentioned IGI had more than 35 lakh shares that have already been traded, 8.5% higher on the stock. 20-day average less than 3 lakh shares. But despite this move, the stock remains below its IPO price of 417 a share.
Take that point, Hormis. Thank you so much for joining us. So let's talk about a corporate conversation now. Reddington reported their Q2 numbers. The company saw their net profit surge nearly 24%, while revenues rose 17% versus last year. V.S. Hariharan, who is the managing director and group CEO of the company, is joining us now on the back of these good set of numbers. 12.5% higher is where the stock is. Thank you so much for joining us today, Mr. Hariharan. Q2 was good, and the stock price shows that as well. But what is the outlook on Q3? How has the demand panned out so far, and which geography is now expected to do well for you?
Thanks, Sonal. Thanks for having me at the show. I just wanted to correct the profit growth. Actually, is 32%. It's 388 crores. And so we had a really good quarter, a balanced growth across all geographies we are in: India, UAE, GCCL, we call the GCC countries, and Saudi. All of them grew 23%, India and UAE and GCCL, and Saudi was at 10% across all business units. SSG, the Software Solutions Group, grew at 48%. The mobility, the smartphone business grew at 18%. And the technology solutions and the PC business grew at 9 and 11. The outlook remains very positive still. All of the geographies we are in are experiencing good tech investments and growth. Clearly, the cloud business, cloud security, software solutions investments in all the geographies we are in, the infrastructure is growing. On the back of that, we're able to sell more of these. The data centers are also growing, so we'll get a portion of that. And it's exciting to see the PC business finally coming back. This quarter, we had a double-digit growth on the back of a bit of 10 to 11 refreshes, as well as slightly higher AI PC penetration. And the second half, we expect more of that. So all of the businesses, software, mobility, and the PC business are all expected to grow. And we do have some big deals in the technology solutions as well in the pipeline and the funnel. So overall, second half looks positive while we've had a fantastic Q2.
What's the outlook on margins, Mr. Hariharan? I think last time you indicated that there could be some pressure on gross margins due to higher large deal wins. And you had given a guidance, I think, operating profit margin of 2.3 to 2.5% ex-Arena.
Yeah.
Do you maintain that, or is there going to be a change?
Yeah, thanks, Rima, for the question. Yes, absolutely. So this the key driver is Software Solutions Group, which is growing at 48%. It's at a higher margins, coming at higher margins. It was 15% of our business last year. In this quarter, we reported 16% of the business comes from Software Solutions. So that's shoring up our margins. Mobility business also this quarter has delivered higher margins. We've had good growth, but there has been constrained capacity as well. So there is a good demand in the premium segment, particularly at higher ASPs. And the PC business with the higher AI PC penetration, we do expect to see a better ASP, average selling prices. So our guidance still remains at 2.3 to 2.5 in the EBIT part of the EBIT metric. Yes.
Okay. And Arena, which is, I think, the Turkish business for you. What is exactly happening over there? And last time you indicated that you are exploring options on what best to do with Arena. I think you're even open to the idea of divesting it, selling it.
All right. So, as you know, Turkey has been stressed due to a combination of reasons. Inflation rates were high. Interest rates on lira were about 50. They've come down to below 40 now. And the market is stressed because the business opportunity is declining. And because of all this, there are also concordat cases like bankruptcy cases, etc. So we've been progressively taking actions over the last few quarters. And this quarter, we actually exited from the Vodafone Arena Connect business. And that was a business which was largely centered around lira. High working capital requirement and at high interest rates, 40+% interest rates, it was becoming a drain. And so we exited from that. It'll take 2, 3, 4 months to execute this exit. We are increasingly focused only on the US dollar business in Turkey and focused on the IT business and really getting the good quality business focus. So we see progress. We're also working on working capital improvements, OPEX improvements. So progressively, we are improving our business there, and we should see our losses go down and turn to profit in the next 2 quarters at most.
Mr. Hariharan, your value business, you have earlier highlighted that you wanted to keep it at 35% as a contribution to the overall business so that to sustain those margins at higher levels. What was the contribution of the value business this time around, and what trajectory do you see for the second half?
You're bang on. So this quarter, the contribution was 35% between Software Solutions Group and the Technology Solutions Group. The contribution was close to 35%. The mobility and the PC business being the balance. And we expect that only to grow in the contribution because the Software Solutions business is growing very rapidly for us at 48%, as I mentioned earlier. And the Technology Solutions piece of the business, we see a lot of data center deals and a lot more deals. So we expect that contribution in Q3 and Q4 to increase only because typically second half we get more value business because of year ends and budgets and all of that. So we do see the contribution going about 35%. We're already at 35 and it'll go more.
Okay, we take that point, Mr. Hariharan. Thank you so much for joining us today with the insights on the business going forward and the growth plans as well. That's Redington, the stock up around 14%. But Ola Electric, that is the stock on our radar, post their Q2 numbers. Sudarshan is here with the detailed analysis. Sudarshan?
So 2 parts in Ola Electric. First, Q2 earnings are looking largely weak. And second, on the outlook front also, company has cut the guidance for FY26, not only for revenue, but also for volume and the margin part. So just if I can talk about the highlights, it was a weak Q2. Losses, company continues to report losses on the consolidated basis. In Q2, the loss was of rupees 418 crore versus loss of almost 500 crore in the same quarter. Revenue has seen a sharp fall of almost 43%. And on the EBITDA front also, it has reported EBITDA loss of around 203 crore versus loss of almost 380 crore in the same quarter last year. Now coming to the outlook. So for revenue, company was earlier saying revenue for FY26 in the range of 4,200 to 4,700 crore. Now that has been cut to 3,000 to 3,200 crore. For auto business EBITDA margin, company had earlier said that in FY26 it's likely to be more than 5%. Now company is saying that it will be around 5%. On volume front, earlier it was around 3.25 to 3.75 lakh units, but now if you do the calculation in first part of FY26, company did the total volumes of around 1 lakh units. Now they are saying that it would be around 2 lakh units. So not only the earnings are weak, even outlook remains muted.
Weak earnings, weak results, guidance cut, and the stock now down around 2%. At 49 is Ola Electric, not only below its IPO price of 76, but also below its post-listing high of 157. Take a short break. The spotlight on the crypto markets on the other side. Manisha Gupta joins in with Mridul Gupta from CoinDCX.
DCX.
Welcome back, and joining us now is Mridul Gupta. He's founding partner at CoinDCX. Mridul, hi, thank you so much for joining in. And what a start to the month of November. While we have seen an all-time high of almost 126,000 on Bitcoin, we've seen that 100,000 breach, even if for perhaps a few seconds, but the volatility has come back.
That's right. And, when it was at $125,000, it came to $115,000. We saw a lot of people participating in the market, and then it again tanked because Fed did not announce a rate cut. Time and again, what it keeps reminding us, Manisha, is that how the prices in the short run gets impacted by all the actions happening across the globe, be it geopolitical environment around various tensions on the cross borders, be it Fed rate cuts and how the US economy behaves, or be it anything to do on the crude oil price movement, etc. Right? So I agree, the market has been very volatile. Good time to start thinking about investing into the market,
Okay.
but at the same time taking a judicious outlook by investing small amounts recurringly versus bulk amounts in one go.
While, of course, there's a lot that's been happening crypto-specific through the year, Mridul, but how would you say, or how would you see, rather, the impact of all that's happening in sense of macro markets here? Is crypto a risk-on or a risk-off asset class? And how long before we see it happen as a mainstream asset class?
It's a 100% risk-on asset class when it comes to short-term, but it's a 100% risk-off asset class when it comes to long-term. So, tomorrow, if, for example, there is more chaos in the world, as a store of value, Bitcoin and other crypto asset classes will shine. But in the short run, when you see steep price movements up or down, it is completely based on the sentiment of the people, because the money is moving from the fixed income and the money market instruments to a more risk-on instruments like equities, etc. And Bitcoin does end up showing behaviors of a risk-on asset class, at least in the short run. So the fundamentals remain strong. So even if the price has moved from 125, gone to a 98, come back to a 103, the fundamentals still remain strong. The inflow of capital, the inflow of users, the inflow of different platforms building on top of crypto, and on top of it, all the regulatory developments happening, that remains strong. But it's very, very important, and thanks for asking that question. In the short run, if a person is investing into the asset class, he should think of it like equities. In the long run, if he's investing into the asset class, he should think of it like gold.
All right. I remember you telling me that it's a global investment asset class in sense of its manner. Mridul, how would you advise people investing within this? Would you say SIP is the best way to do it? And also with the kind of institutional adoption, corporate adoption, even treasuries getting into it in the global markets, how would you look at 2026 panning out for it?
Yeah, so I think the good thing about the markets is that it has room for every kind of investor. I would say that if you have not started your crypto journey yet, come and start it with a SIP product. We also have it on CoinDCX. A lot of platforms have it. It helps you make sure that you're not timing the market and you're always in profit. So we have seen a lot of people put SIP on our platform, and all of these people have been profitable over a longer run. right? So if you're starting your journey, if you don't want to go into the technicals of the market, start with SIP. If you have evolved to a level above and you are able to understand the dynamics of the market, you could try your luck with leverage products. If you don't like leverage, but you are deep into crypto, you could try with the newer projects coming on the blockchain and getting launched and getting traction. You could go into the fundamentals of these projects and start doing more long tail token investing. But I think different flavors for everyone. But the bulk of the people who have not yet started their crypto journey should definitely look at SIP. It's the single most useful tool on any platform to make the user profitable over a long run.
Mridul, as you mentioned that with the kind of correction that we've seen in prices, perhaps a good time to start investing within. Going forward, as we are talking about macros, if a US Fed rate cut does not happen in the month of December, and with the kind of moves that we're looking at as we get into the new year with dollar index slightly on the higher side, slight risk off in the international markets as well, how is all of this going to impact the prices?
So I would say that any risk-off sentiment does have the tendency of bringing crypto prices down, starting with Bitcoin and then moving into other tokens. I would say that a lot of it is baked into it already. We have seen 20% price correction over the last month. So a lot of it is baked in already. But if the market markets are markets, right? If the market is expecting a rate cut, but the Fed does not do a rate cut again, we will see some price correction happening again. And hence, especially in the volatile times, I urge investors to, number one, if they're trading on leverage products, reduce their leverage. Don't trade 10x, maybe trade 3x or the 4x. Number two, don't trade in illiquid tokens. So focus more on blue chips, focus more on mid tail, but don't go towards a long tail because the price movements there can be 100% up or down. And number three, if they don't know what to do, then instead of being completely isolated from the market, jump towards a spot portfolio and start doing SIPs because that way you are more tuned into the market. You keep understanding the fundamentals and the technicals, and you are not putting a lot of capital at risk on the trading platforms.
All right, Mridul, thank you very much for that very, very sane advice. And with that, that's all the time that we have in this segment. Appreciate your time. With that, we'll slip into a short break. More on the markets on the other side.
CNBC-TV18 presents Crypto Corner, powered by CoinDesk.
Welcome back. Let's put the spotlight on the AI sector. Lim Wen Long from White Oak Capital is now joining us here in the studio. Thank you very much for joining in here. So you're sitting in Singapore and you're making the investments for White Oak Capital in emerging markets ex of India.
That's right.
Right. So tell us what you like right now, first as a top down, and then we'll get chatting about AI and whether you fear that there is a bubble building up.
Sure. So at White Oak, the way we invest is very much bottom-up stock picking. So we're actually finding ideas all over the markets. So be it the sectors that you've just touched on, be it things like electric vehicles, humanoid robots, sectors like entertainment in Korea. So, companies that are involved in K-pop. So they're across emerging markets. We're genuinely finding ideas all over the place at the moment.
Okay, and how do you feel about AI? There is fear of a bubble building up. Where do you stand on it?
So I think it's a very interesting place to be at the moment. So if we think about past bubbles like the dot-com bubble that we've seen, the internet bubble back then, it was all about hype and there was no earnings growth to go along with it. But today in the AI world, yes, there is definitely some hype and some excitement there. But the earnings growth that we're seeing is actually real. So you're seeing NVIDIA and a lot of these other companies delivering numbers. So if we look at the supply chain for AI hardware, that's actually coming almost exclusively from Asia, particularly Taiwan and South Korea. So a lot of opportunities over there.
So which part of the value chain is looking very interesting to you where you don't think there's a bubble or a valuation trouble right now?
It'd be fair to say that there is excitement in most parts of the supply chain, but I think if you kind of look beyond the obvious names. So one thing about White Oak is we have teams on the ground in a lot of places and a very big team. So we like kind of digging through the weeds for maybe the lesser known opportunities. So if you look at maybe the hardware that supports some of AI, so be it power supply or be it custom chip designers, we think in these more niche sectors, you might find better opportunities.
But there has always been this worry about, you mentioned there is earnings growth, but is it justifying the kind of numbers that are being thrown out, right? Every other week you see a $50 billion, $100 billion deal that OpenAI is signing with companies. Where are they going to get that funds to finance those deals, and when do you even start realistically expecting a return on such kind of investments?
So I think the second part of the question is the critical one, because the first part, if you think about the hyperscalers who are spending the money, Google, Amazon, Meta, they have a lot of cash on their balance sheet. So a lot of this spending is being funded by cash at the moment. It's when companies like Oracle who start funding things from debt get involved, that's when the risk level starts to tick up. So in terms of the return, that's the critical question, right? I think that's the harder question to answer, because at the moment, for a lot of these companies, AI is a winner takes most market. So this is something that they have to spend on. Otherwise, their future business model is at risk. But at some point, you're right, that return will need to be earned. And that's what we're all waiting to see, when and how that comes about.
So, when we talk about AI, is usually what's happening in the US, as Hormuz also mentioned, we are talking about those big deals that keep getting announced. How is Asia positioning itself when it comes to AI? We largely talk about China, but there's Korea. You named other countries as well. Where does Asia stand in that point of view?
I think at the moment, Asia is very much the picks and shovels. So there is no AI without the companies in Taiwan, without the companies in Korea. All these companies that supply the tech hardware that goes into AI, we actually think that they might offer a very attractive opportunity at the moment, because whilst we argue about, who's going to get a return on their capex, the companies who are supplying the picks and shovels, they don't mind, because they're the ones benefiting from the capex spend.
So that becomes the opportunity as compared to the hyperscalers, is what you are trying to highlight.
Yes,
exactly. It's more attractive in Asia versus the US markets right now?
I would say, if you're picking between the hyperscalers, you're kind of deciding who has a better model, who might end up being the winner, and you have to make a decision on that. And sitting here at this point in time in such early innings of the AI revolution, it's hard to do. Whereas within Asia, companies who are there in the supply chain, they're supplying to all of these guys. So to them, they're not so bothered with who ends up winning, because they'll be selling to whoever is left.
You would be comparing notes with your counterparts in India when it comes to technology. What do you all make of India's semiconductor aspirations at White Oak Capital?
Yeah, so this is a really interesting question. So I've had a lot of conversations with Neeraj, who covers that from Mumbai here. I think in the initial innings, if you talked maybe 12 months, 18, 24 months ago when semiconductors in India was first being announced, there was a lot of excitement that was going through the market, and maybe some of the deals that were being announced were maybe less realistic in terms of what could be achieved. But sitting in Singapore today, looking at what's happening in the Indian market, it's actually a lot more exciting, because I think India is now playing to its strengths, a skilled labor force, abundant labor, entering the back end part of the semiconductor process where these kind of advantages make a difference. Then you build up the skill set there, and then you start integrating into the more value-added parts.
So, when we talk about, the earnings growth that would come by, or the opportunities that we have in the AI space, which Asia can build on, what are some of the risks in the immediate future that you think investors should be wary of?
I think within a sector where there is as much excitement as AI, it's always short-term volatility that happens. I mean, we saw it just last night, 2 nights ago in the US. Just, a little bit of commentary and you see some volatility. So I think having the appetite to digest that kind of short-term volatility is one thing. But maybe the second part to think about is there are some companies where 80-90% of their revenues would come from AI at the moment. If that AI spending were to go away, these companies would be very badly impacted. But equally, there are a lot of companies where AI is a nice growth driver, but maybe 20-25% of revenues. If AI were to go away, those kind of companies would be more sustainable. So there are different ways to approach this, and it really depends on your appetite for risk and how you want to play it.
Interesting but short conversation. Long, thank you so much for sparing time and joining us today, and look forward to having you more often in India.
Thanks for having me.
A good stay.
Thank you.
Take a short break here on Trading Hour. Back with more on the other side. Stay tuned. At the lowest point of the day now is the index, but the one sector that has been in the spotlight all through the day has been the paint sector. That is our big story, and this is after the Birla Opus CEO Rakshit Hargave stepped down. Mangalam is here with more on this and the potential impact on the sector.
Never short of excitement and colour, the paint industry. What was supposed to be an insipid quarter and a midweek holiday had a splash of management change, and that exactly has now caused a flutter among all the paint stocks in today's trading session. So the big news that came in yesterday was Rakshit Hargave has resigned as the Birla Opus CEO to pursue an external opportunity, which we were apprised of yesterday itself, where he will now join Britannia as the CEO for the next 5 years. Remember, Rakshit was, appointed at Birla Opus and stood through its launch. 18 months into Birla Opus's launch, all the 6 factories coming on stream and them reaching a near 1,000 crore per quarter sort of run rate as well. Birla Opus on its part says that they continue to gain market share, and now their market share is double digits if you compare, with the organized decorative and putty industry. And the total capex that they've spent is close to 9,700 crore rupees, as against when they started out, the money that they had earmarked, which was close to around 10,000 crore as well. So a lot of good things done for Birla, and now this Rakshit Hargave's resignation has caught the street by surprise. But on its part, Berger Paints this morning said that the worst of competitive intensity is behind, because now Birla Opus for the last few quarters has stabilized at 900 to 1,050 crores per quarterly run rate, and they can't discount any further if they have to reach their stated objective of 10,000 crore revenue and EBITDA break-even by year 3 and of operations itself. And Nomura, on the back of that, they've turned positive on the sector. They've said that competition headwinds are now behind. Remember, Birla Opus's 10,000 crore capex is deployed already. If they want to further disrupt the category, they will have to put in more money. And at the same time, these stocks have already seen a correction as well. Last financial year, from the peak, Asian Paints had seen a correction of almost 30-35%. From a valuation standpoint as well, the last 5 years, Asian Paints was trading at an average of 60-62 times 2-year forward earnings, and now it's come down to around 50-51 times itself. So with the worst of competition behind, raw material prices being benign, and at the same time, the best of demand ahead after an extended monsoon that impacted performance, the street believes it's time to now get positive on the sector. Nomura has actually upgraded Asian Paints to a buy with a target price of 3,100 rupees, and that is explaining the sort of red and green moves that we're seeing on Grasim and Asian Paints respectively. A lot of excitement, a lot of color. Let's see where it goes.
Oh, yes. In fact, thank you so much for that, Mangalam. In fact, earlier we spoke to Abhijit Roy, who is the Managing Director and CEO at Berger Paints. Let's listen into excerpts from that conversation.
Quarter 2 of last year, since they had started just about that point of time, they had done about 450 odd crores as per their own analyst meeting, because it's not a published result, so we don't know. But it's around that figure. And this time they said that they have done about 110% odd growth. So we can assume that it's about 950, 960 crore, which is slightly below the first quarter of this year. And that's what they said, that they have done slightly below last year. Now, if you look at next quarter, and they have been doing around these figures, quarter 1 also was like that. Quarter 4 of last year was also similar. Quarter 2 of this year also is similar. So it's around that 900 to 1,050 type of level at which they have settled out. The business will carry on as usual. That will happen, but the tapering is also happening. We compete in the market by giving some discount to the leader as well. So it's not something which is very disruptive as far as we are concerned. So from that perspective, I don't see that, really impacting. They have also indicated that in 3 years they will become profitable. If they have to do that, they cannot, discount, massively from here on.
Time for a short break. We'll get you excerpts from our exclusive conversation with the management of SRF on the other side. Stay tuned.
Welcome back. You're still tuned into Trading Hour in a rare and exclusive conversation. SRF's top management tells us they are looking at a 15% growth going forward in their consolidated business year after year. And also, I spoke to Mr. Ashish Bharatram, who is the chairman and managing director of the company, along with Karthik Bharatram, who is the joint managing director, on business, strategy, tariff impact, and long-term growth plans, and a lot more actually. Listen into what they had to say.
Yeah, I think there's no doubt about the fact that tariffs have created a lot of uncertainty in the system. This 25% penal tariffs on India, I think, was something that we didn't expect. While President Trump has been sort of, he says a lot of things, doesn't do that, and then says something else and does something else. But I think this really hit us badly. And for the last 3 months, there's no doubt that the exports to the U.S. have been impacted. The US is a very important market, not just for SRF, but I think for a lot of companies out of India. So we are sort of hearing that, there is some sort of a deal on the anvil, and, but, we've heard about that in the past as well. But till we finally hear the announcement, obviously, it doesn't mean anything, but we're all hoping that that does come around, because the US is the biggest consumer market in the world. And I believe that we need to find an answer there.
Okay, and that's about the tariff bit. What about what's happening with the chemicals industry before tariffs? You have been changing your tones. It was, okay, there's some issue. Then you became cautiously optimistic. There was a time when the understanding was second half of FY25 could get better. But now it's second half of FY26. What's the long-term strategy on chemicals business overall?
So I think it's a bit of a mixed bag. I think we all need to understand, first of all, that when it comes to chemicals, it's not the US. The big daddy in the room is China, right? And China, I think, just post-COVID added so much capacity across various sectors. And, their philosophy has been that even if it means bleeding for 8 years, 10 years, etc., they get the support from the government to deal with those downtimes. But they just want to grab market share everywhere. And, that's basically been what their philosophy has been. So companies like ours, for example, have to find niche areas of being able to compete with them and so on. One of the sectors that we supply to in the specialty chemicals business is the agro sector. The agro sector, unfortunately, has also got very badly hit because of the tariffs and so on, because the US used to sell a lot to China. They've had a lot of soya, etc., that's lying around, nobody's buying. So the agro cycle in the US is just going through a really tough time. So there is chaos in the system, and what we thought would be a recovery in the second half of 26, I still feel that this recovery is going to take longer for it to come back. But on the positive side, we are seeing a lot more traction on the refrigerant gas side, etc., because to some extent the quota regime has come in America, the quota regime has come in China, and that's something that is going to probably play out well for us in times to come.
You have films, which is a big business for you as well. That also went through that uptick during COVID. We had supply disruptions, but now there's oversupply in the market. How do you decide that you have to put capex in an already oversupplied market?
So I would put it differently. Again, yes, you're right that business is more cyclical than our chemicals business, and we have less of a moat over there that's compared to the chemicals business. But I think at the same time, we've got to understand that there are many opportunities. So one of the reasons we changed the name of the business from packaging films to performance films and foils is also because we're moving into a new sector in films, where, for example, we're getting into what's called capacitor grade films. These are used actually in the electronic space as capacitor films. We are in the foil business, for example. While we started off with packaging, our longer-term goal is to get into battery foils. Similarly, we're looking at some new opportunities over there as well to come into new segments. So the idea is to move beyond packaging and get into certain other sectors which are a bit more niche. Obviously, that's something that we have to see how India's electronics sector grows in the next 5 years. But I think the push that the government is making in that area will help. Will help us sort of be able to take advantage of that. And I think, again, where SRF is able to sort of differentiate is that we're very comfortable working with the organized sector. I think we're very comfortable working where there are stringent processes, systems required, and I think those are the customers that we'll be dealing with when we get into this space.
So coming to the electronics manufacturing scheme, SRF is one of the participants, right? So what's the role that SRF will play in that entire scheme? What kind of capex will you be putting there? When does that start?
So it's a two-stage capex. The first capex is actually going to be online in February, and the second will probably be, we'll go to the board sometime middle of next year. As soon as we've got that streamlined, it is a very new technology to what we've done in the past. So we just want to make sure that we get our hands wet, we understand exactly what it's all about. And once we figure that out, we'll go with the second plant. But the total capex there could be in the region of around 500 crores. Over, so around 270 crores are going in now, then we'll put in the next.
Okay. What is the general asset turn on the entire capex that the company has, trying to understand the return possibility?
So we don't look at the asset turn as much. And I'll tell you again, the point that you made earlier that, sometimes turnover could be a little bit of vanity, because a lot depends on what your raw material costs are. So in a business like packaging, if you're in a down cycle of the petrochemical chain, then everything falls. So your revenue falls as well, right? So on the other hand, if everything goes up, then suddenly you find your revenues go up and so on, but your EBITDA margins fall. So if the raw material is lower, you normally end up with higher EBITDA margins, and if raw material is high, you actually end up with lower EBITDA margins. So our focus is generally on ROCE, because I think at the end of the day, what we really focused on is, listen, for the amount of money that we've invested, what is the sort of return that we can generate. And so for the performance films and chemicals, our goal has always been to look at something in the region of 16 to 17% ROCs, and the chemical sector upwards of 20.
So when you said you have to create value for the 50% remaining owners as well, do you think that would happen by demerging the three segments?
That's a question that keeps coming every now and then.
It had to come.
Yeah, it had to come. No, I think it's a tough one, because one major advantage that we get is the fungibility of cash. So, for example, the technical textiles business is much more of a cash cow. And for us, in that sense, if that business was on its own, the question would be what would we do with the cash that it generates? This way around, when you look at it from an SRF's perspective, we're able to use that cash to actually grow the chemical business and the packaging films business. So, it's just a question of what actually makes better sense for the shareholders. But I'm not going to say that it'll never happen. It is possible that down the line, the packaging business might just grow to a level where, if it is actually now, self-sustaining, it doesn't need any support, and then one could look at it differently.
When you said packaging reaches a certain level in terms of revenues, that's when you could think of getting it demerged. What is that revenue level or capacity level?
I think once I'm comfortable that, on a perpetual basis, maybe, they can earn more than 1,000, 1,200 crores of EBITDA on a annualized basis. Maybe at that stage, one will be more comfortable looking at it.
Oh, okay, all right. So chemicals will continue to be more than 60% of your overall business?
For sure.
And what kind of growth are you envisaging? I'm not saying short term, but with the kind of investments that you have?
Yeah, our aspiration has always been to grow in the region of 15% per annum. I think, when you grow at 15% per annum, you're obviously, growing at a level which is much faster than where the GDP of India is. Even if you take nominal GDP, you're growing at a much faster pace.
There's a capex announcement almost every quarter from SRF. It's known to be doing that. How do you decide where will the next leg of growth come from? And between the three segments, where do you think will the growth come from for SRF in the next 3 to 5 years?
So, Sonal, I think it's definitely going to be to a large extent from the chemical sector. I think, what we've been able to do in the chemical sector is really create this strong, what we call the chemical technology group, which is our R&D, engineering, and so on, to be a differentiator. Okay, I believe that for a country like India, we are now getting to a stage where the economy closing in on $4 trillion is going to require a lot more chemicals to be produced internally if you really want to keep making the leap. When we spoke about China in the past, I think what allowed China to grow exponentially was the fact that they just had every basic chemical available in their ecosystem, that it could move from here to there, and they could develop newer and newer things.
I just want to add something there, Sonal. China has 40% of the world's chemical market in terms of production. We have 2.5 to 3%. So India is still minuscule in the world thing. So even when you add 1% or 2%, that means a huge amount for India, while it may not amount to a huge amount in the global thing. So therefore, I really do believe that the potential that India has in the chemical thing, as Ashish mentioned, especially those who have the R&D, who have the teams to be able to develop these new products, it is immense. There are hundreds of thousands of chemicals. The number is just huge, right? So many opportunities in many areas in terms of where one can look at growth in the chemical sector.
A very interesting and exclusive conversation with the management of SRF. Take a short break, but here's a programming note. The final countdown for CNBC-TV18's most anticipated event of the year, the CNBC-TV18 Global Leadership Summit. This year, the summit spotlights the India advantage, the country's unmatched potential in a shifting global order, catch business leaders, policymakers, explore transformative strategies and groundbreaking ideas. Starting 8:30 a.m. on the 7th of November, it will be a power-packed day with several panels focusing on India's economy, digital landscape, markets, entertainment, and a lot more. Tell us why you love CNBC TV18 by sending a tagline on the email address flashing on your screen, and you stand a chance to attend this marquee event. Welcome back. Just before we call time on the show, some commentary from Blue Star on the earnings call, as a result of which the stock has now slumped to the lows of the day. The two important takeaways: the management believes that the second half will be better than the first, but they are doubtful that it will make up for the loss that you've seen in the first half. And FY26 will be seeing flat growth on a year-on-year basis. The stock now down 2.5% after starting off higher. Take a leave on this edition of Trading Hour from Zonal, Rima and me. Thank you for watching. Halftime report on the other side.